a stock that most people have never heard of, just moved 16% in a single trading session, and the volume behind it suggests this was not retail traders on a forum. BFLY Network, ticker BFLY, printed one of the more dramatic single-day moves in the medtech space in July 2026. But here is the question that actually matters. When a sub-$2 billion company surges 16% on heavy volume, are you looking at the beginning of a genuine re-rating? Or are you standing at the edge of a cliff right before the institutional sellers show up? Let's establish what we know. BFLY Network is not a household name, but its technology is genuinely interesting. The company makes a handheld, AI-assisted ultrasound device, the IQ3, that plugs into a smartphone and retails at a fraction of the cost of a traditional cart-based ultrasound system. Their pitch is democratizing diagnostic imaging, particularly in underserved markets and emergency settings, where a $50,000 radiology suite simply does not exist. Now, a 16% move on above-average volume does not happen in a vacuum. In BFLY's case, a move of this magnitude in mid-2026 is most likely tied to one of three categories: a material contract announcement, a partnership with a health system or government agency, or a meaningful update to revenue guidance or path to profitability. Companies at this market cap stage, BFLY has been trading in sub-billion territory for most of its post-SPAC life, are binary in nature. The right news from the right counterparty can reprice the equity dramatically. What sophisticated observers watch in these moments is not the percentage move itself. It is where volume comes from. A 16% move driven by options activity and social media chatter is very different from a 16% move where institutional block trades are hitting the tape in size. The latter suggests someone with a research budget has decided the prior valuation was incorrect. The actionable insight here is foundational. Before you evaluate any catalyst, you must first understand the business model. If you cannot explain in 2 sentences what BFLY sells, to whom, and at what margin, you are not evaluating a catalyst. You are reacting to a number on a screen. Here is where most YouTube finance content will fail you. It will celebrate the move without ever asking whether the market is being rational. BFLY Network has been a challenging story by the numbers. Since its 2021 SPAC debut, which valued the company at roughly $1.5 billion, BFLY has spent most of its trading life significantly below that figure. A common outcome for SPAC-era medtech companies that were priced on optimism rather than operating leverage. Revenue growth has been real, but uneven, and the path to positive EBITDA has shifted multiple times. So how do you evaluate whether a 16% single-day move is justified? You run 3 filters. First, what is the revenue multiple at the new price? If today's move pushed BFLY to a price-to-sales ratio above 8 or 9x on forward estimates, and the company is not yet profitable, you are paying for a future that has to execute perfectly. Second, what is the competitive moat? Philips, GE Healthcare, and Fujifilm are not sleeping. BFLY's advantage is software intelligence and price point, but that moat has to be consistently defended. Third, what is the insider and institutional ownership trend over the prior 2 quarters? Smart money accumulating quietly before a catalyst is a fundamentally different signal than smart money selling into strength. The honest assessment is this: a 16% move in a company with genuine technology, a real and growing addressable market in point-of-care diagnostics, and improving unit economics is not automatically irrational. But at the elevated price, the margin for error collapses. The move may be justified as a re-rating of probability. The market is assigning higher odds to a successful outcome. That is not the same as the outcome being guaranteed. And just to be explicit, none of this is financial advice. These are analytical frameworks, not buy or sell signals. If you are earlier in your investing journey, today's BFLY move is a masterclass in a trap that destroys capital consistently and quietly. It is called performance chasing, and it is arguably The single most expensive cognitive bias in retail investing. Here's how it plays out. A stock moves 16% in a day. You see it on a screener or a financial news feed. The instinct, backed by a dopamine system that evolved to respond to fast-moving things, is to view this as evidence that the stock is worth buying. Something happened. People who bought yesterday made money. Maybe you should buy today. But here is what the data says. Academic studies of momentum in small and mid-cap equities, including work published in the Journal of Finance and by factor researchers at AQR, consistently show that extreme single-day moves in stocks with below-average liquidity mean revert at higher rates than they continue. A 16% pop in a stock trading under $3 billion in market cap is not a confirmed trend. It is an event. Events and trends are different things, measured on different time horizons, with different risk profiles. The sophisticated approach is to put the ticker on a watch list, not a buy list. Give it 2 to 3 weeks. Watch whether the volume sustains. Watch whether the price holds above the breakout level or collapses back into its prior range. Watch for a secondary announcement that confirms the catalyst was a signal rather than noise. The best entry into a real momentum story is rarely the day of the initial move. It is the first higher low after the dust settles. Some of the most disciplined traders in this space, people running quantitative long-short books, specifically avoid the first day of a move and look for confirmation before adding exposure. There's a reason for that. The first day belongs to the people who knew. The second and third days, if sustained, belong to everyone else. That is where the asymmetry shifts in your favor. Patience as a competitive advantage in a market full of impatient capital. We opened with a simple question. Is BFLY's 16% move the start of a re-rating or a trap? The answer is, it depends on which framework you apply. The catalyst matters. The valuation at the new price matters. And your entry timing matters most of all. The follow-up question worth answering. What does Butterfly Network's balance sheet actually look like heading into the second half of 2026? And does it have enough runway to reach profitability before the next capital raise? That video is coming. Subscribe so you do not miss it.